The CEO of BlackRock, Larry Fink, has issued a number of major warnings about the future of the American economy in his annual letter to shareholders, as well as the dangers of continuing on the current trajectory for certain problems that we are facing. Now, BlackRock is the world's largest asset management company with $10 trillion in assets under management, so when their CEO raises red flags on a number of things, it is certainly worth listening to and taking note of what he says. Now, the first big warning that he makes is the looming retirement crisis that America is facing and what could happen to the US economy if nothing changes. Based on UN projections, the number of people globally over the age of 65 will rise to 1 in 6 people, up from 1 in 11 people just 5 years ago in 2019. And this year, a record number of baby boomers will reach the traditional retirement age of 65, and by the year 2030, they will all be 65 or older. This wave of new retirees are set to live for longer than before thanks to an ever-growing life expectancy, and Fink has warned that there is now a massive strain on the government Social Security retirement program that is partially due to people not contributing enough towards their pension plan. He writes, "We focus a tremendous amount of energy on helping people live longer lives, but not even a fraction of that effort is spent helping people afford those extra years. Today in America, the retirement message that the government and companies tell their workers is effectively, you're on your own." He also describes the mismatch between what Americans are saving and what they would need for retirement as a problem so big and urgent that government and corporate leaders need to stop business as usual and step out of their silos and sit around the same table to find a solution. A US Census Bureau survey found that almost half of Americans between ages 55 and 65 have no savings in personal retirement accounts, which is partly due to the tens of millions of workers who are in part-time or gig jobs that offer no clear retirement contribution plans. Now, this is all a massive concern when we consider the state of the current Social Security system, with the administration itself saying that by the year 2034 it will no longer be able to pay people their full benefits. Now, with full benefits no longer being provided through Social Security, people are not going to be able to survive solely on just these payments from the system, meaning that all of the people who have little to no money in their private pension are in a terrible situation. There are a number of big reasons why the future of the Social Security system is at risk right now and could end up failing in the coming decade. Not only are life expectancies rising as mentioned earlier, but birth rates are also declining at an alarming rate too, meaning that there are less new workers entering the workforce to essentially replace those people who are retiring. And this problem won't be going away anytime soon, even after the last of the baby boomers retire, as we will continue to face a massive wave of people nearing the end of their time in the workforce who are entering retirement. Now, while the birth rate continues to decline, we are only going to see this gap between the number of people leaving and entering the workforce get bigger and bigger, which continues to put more stress on the Social Security system and more strain on the government budget to support this scheme. In fact, when we look at this chart showing payroll revenue versus benefits, we can see that for the last 15 years, the US government has been paying out more in benefits than it has been collecting in Social Security revenue. There is now a clear gap that has emerged between these two metrics, which is only going to grow as the demographic imbalance worsens. There is fortunately a chunk of money that remains in the pot to cover this deficit in Social Security payments, at least for the time being, of around $2.8 trillion. However, this has started to be depleted and will continue to deplete to zero unless something does change. And as mentioned, at the current state, all of this money will be gone by 2034, which means that all retired people would see an instant decline to their pension unless the government starts to fund the program from other tax income. This, however, would put even more strain on an already widening government budget deficit that we are seeing. With so many people having little to no retirement savings and 40% of current retirees relying solely on Social Security to live, this older age group may have to find other means to sustain themselves through retirement, and this could have a lot of knock-on effects on other markets and areas of the economy. One of these trends that we could see is retirees selling their homes to downsize, find a place to rent, or move in with their children. Now, more than 1 in every 3 homes in the US is owned by people over the age of 65, which is quite a staggering statistic. Ever since the late noughties, the over 65s have been growing their share of total US home ownership quite rapidly, while simultaneously all those under the age of 54 have seen their share decline. Owning a substantial sized home is not so fun once you retire and your income is slashed, as utility bills, maintenance and property taxes don't disappear. If a lot of these retirees don't have much income coming in to sustain these home costs, which would be made even worse with reduced social security payments, it would make sense to see many of these people cash out their home for a big lump sum of cash. Now, house prices have seen substantial gains over the last decade or so, and with many of the older generations now having paid off their mortgage in full, or at least owning a significant equity in their homes, a lot of those over 65s are sitting on a goldmine in home equity that they could tap into. There are approximately 144 million homes in the US, and we know that over 65s own 34% of these homes, which equates to about 49 million homes. Even if we see just 10% of these over 65s be forced to sell their homes in the coming 10 years or so, this is going to be 4.9 million homes being offloaded to dilute the market. If we look at the housing inventory data, we can see that there are 664,000 active listings for homes right now. Now obviously we see homes get bought and new homes get listed on a daily basis, but this excess of 4.9 million homes that could potentially hit the market in the coming years from these distressed retirees who are moving into rented accommodation or moving in with their kids is a very significant sum. This is going to put a lot of downwards pressure on the housing market, which could lead to home prices seeing significant declines as a result of this. Larry Fink has also issued a warning about the US debt problem in which government spending is totally out of control. He mentions how the general infrastructure investments have been signed into law but have $2 trillion worth of deferred maintenance, and questions how exactly we will pay for all of this. Since the pandemic, the US has issued $11.1 trillion of new debt, despite the rate on a 10-year Treasury bill rising from under 1% to now being over 4%, and Fink says that the situation is more urgent than he can ever remember. One of the reasons why this debt is becoming more and more of a significant problem is because America is paying for old debt by issuing new debt, but it's now running out of investors who are willing to buy these new treasuries at the volume or at the premium that they currently do. Today, around 30% of US Treasury securities are held by foreign governments or investors. However, this percentage is likely to go down as more countries build their own capital markets and invest more domestically. China is one country, for example, that has been aggressively dumping US Treasuries, drastically reducing their holdings in the last 10 or so years. Fink compares America's snowballing debt situation to Japan in the 1990s and early 2000s, where debt exceeded GDP and led to periods of austerity and stagnation. A high-debt America would make it harder to fight inflation, since policymakers could not raise rates without dramatically adding to an already unsustainable debt servicing bill. Another very interesting thing that Larry Fink has warned about in this BlackRock annual letter to shareholders is the current level of fear and pessimism that Americans have regarding the economy. Compared to 20 years ago, the current cohort of young Americans is 50% more likely to question whether life has a purpose, with 4 in 10 saying it's hard to have hope for the world. Now, with the number of global conflicts that have taken place and continue to take place across the world in recent time, it's not hard to see why there is more of a pessimistic view compared to 20 odd years ago. Fink says that the lack of hope worries him as BlackRock CEO, and adds that if future generations don't feel hopeful about America, then it will lose the force that makes people want to invest. He also says that we risk becoming a country where people keep their money under the mattress and their dreams bottled up in their bedroom, which is quite a damning prediction of where the future is heading. Now, this is obviously a very broad and generic warning by Fink, but it is worth considering what this could all mean for the future of the American economy and capital markets in particular. If people are taking a more risk-averse approach to investing, then this could mean that it's harder to raise money in private funding markets, which would make it harder for new and exciting startups to raise the cash that they need. It could also mean that the stock market performs worse over the next 20 years compared to the last 20 years, but let's be honest, nobody really knows what is going to happen, and this could just be a bit of a throwaway comment from Fink in this letter. Now, the problems mentioned so far are not the only major headwinds that the US economy is facing right now, and looking at some more data, it looks like a perfect storm for economic collapse is brewing. I cover this topic in my previous video, which you can check out by clicking on screen right now. But aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.